Welcome to today's episode on governance oversight with respect to BRSR. I would like to thank everyone for taking their time in joining us today. I'm Simoni Rathod from Lodha & Company ESG Practice. Lodha & Company is one of the oldest audit and assurance firms with 6 offices all over the country. Today is the 4th episode of the webinar series on ESG reporting by Indian corporates. In our previous episodes, we discussed about the various types of disclosures under BRSR, the MCA's national guidelines on responsible business conduct, the policies and procedures required for ESG integration. Today, we will understand how governance plays a role in ESG reporting. The purpose of the webinar is purely informational, and any kind of compliance decision should be referred to a professional advisor. Attendees can watch our previous episodes on the YouTube link, the link of which is available in our webinar chat box. In the case of any comments, questions, clarifications, attendees can raise their hands or post them in the live chat box, and we will happily address them after the session. Attendees can also write to us at esg@lodaco.com. Attendees are requested to stay on mute at all times during the session. As the India INC is now gearing towards environment, social governance integration, much of the focus is on the environment and the social parameters. Very less focus comparatively is given on the governance parameters. Entities now should realize that in addition to being 1/3 of the ESG equation, the governance is also foundational to the realization of both environmental and social. Behind each breach of a company's environment and social commitment lies ineffective corporate governance. Further, corporate governance affects the integrity of ESG disclosures in determining whether ESG indicators are ethically pursued and reported. Generally, what is corporate governance? Corporate governance means a set of systems, procedures, practices, policies, standards that are put in place by a corporate to ensure that the relationship with various stakeholders is maintained in a transparent and honest manner. To understand what is governance in ESG, it is basically balancing the business decisions to serve all the stakeholders equally. The board of directors is mainly involved in crafting the policies, and therefore they are ultimately responsible for overseeing the governance, whereas the managers at the lower level contribute to the overall ESG compliance in the end. The understanding of corporate governance in ESG is evolving alongside the rise of ESG. It generally predates environmental and social risk as a corporate priority. Now, due to the lack of comparative attention on the governance factors in the ESG, it has led to a lot of confusion about the nature and role of corporate governance within the ESG framework. So to clear this confusion, the World Economic Forum has developed a list of governance factors that should be included within the ESG within the governance in ESG. The nature and deployment of these governance factors will vary based on the industry. For example, those in the FMCG should consider the importance of responsible advertising, while those in the financial service industry should consider the issue of data breaches. If thoughtfully deployed, these factors will also ensure that the G in ESG is adequately represented in rating and reporting frameworks. So let's understand these governance factors. In case of business ethics, the purpose, the values, the culture within the organization, the integrity beyond compliance, ESG integration, pursuit of and reporting on the key performance indicators. When it comes to the board composition, the competency of the board, the diversity of the board, the structure, the various committees that are formed within the company, the capacity, the oversight capacity of the board, the independence of the board, all of these matters. When it comes to corporate leadership, the tone that is set within the organization, the knowledge, the experience, the power of the power allocation, which is the delegation of responsibility, the compensation, the decision making processes, the independence and empowerment of compliance function. When it comes to risk and crisis management, the preparedness of the entity against the risk, the mitigation measures that are taken, the past performance of the entity, the regulatory compliance, the segregation of duties, audit independence, shareholders' rights, information governance, cyber security. All of these are the matters of consideration when it comes to risk and crisis management. When it comes to resource allocation, capital allocation of the entity, personnel allocation, mergers and acquisitions. When it comes to incentive structures, the compensation provided, the remuneration decided for the manager personnel, the promotion, the reporting structures, the defined whether the entity has defined prohibited misconduct, disciplinary measures that they have taken. When it comes to stakeholders engagement, understanding the corporate impact and stakeholder priorities, whether the entity has identified the various stakeholders, the material stakeholders, whether they have considered their issues within their decision making, pursuing the stakeholder centered practices. When it comes to political responsibility, lobbying, amicus briefs, campaign finance, political contributions, these factors should be considered. When it comes to transparency, the ownership, subsidiary holdings, open contracting, or lobbying, charitable donations that are given, countries of operations, verifiability of disclosures. When it comes to anti corruption and integrity, the training and communication that is provided within the organization, the whistleblower mechanism that is set up, the due diligence undertaken, the risk assessments done, public procurement, government relations, gifts and entertainment, conflicts of interest, the remuneration and payment procedures, record keeping, financial controls, reporting and accounting, contractual obligations, the public commitments, past incidents, internal investigation, and remediation. When it comes to tax strategy, tax compliance, anti-tax avoidance, and tax disclosures are need to be considered. When it comes to fair competitive practices, anti-collusion, anti-exclusion, anti-monopoly, anti-coercion, market-based pricing, all of these factors need to be considered. When it comes to supply or value chain management, how ESG is integrated when it comes to value chain management, the transparency, the contractual obligations in the countries that they are operating, so the countries of operation. Now, I would like to pass on the virtual flow to Mr. Manishankar Prasad, who will take the conversation further. Mr. Manishankar Prasad has 14 years of experience in environment and social consulting from across 10 countries, Asia and Africa. He is currently the Vice President of Lodha & Company ESG practice.
Absolutely. Many thanks, Simone, for the wonderful introduction to the presentation. Regarding the factors about the G, about what exactly, how do we operationalize the aspects of G when we are talking about ESG? And as an environmental and social practitioner, one can definitely tell that the emphasis on the E is often the maximum when we talk about ES and G, and even social elements are not really foregrounded in a very comprehensive manner, whereas human capital in terms of labor issues are not even considered. Whereas even in the E aspect, environmental aspect, right, we only consider the climate factors as predominant, and if we look at ES and G as factors within our index, um, because most professionals who are doing ESG are mostly from an environmental background or from a science and engineering background, the E and the carbon within the E itself is over-indexed. So the conversation on G is a refreshing, refreshing note to end the year with, because a lot of the conversation in ESG is a strategic conversation. It's a conversation which happens from the board level, from top down, where culture is set, uh, f- absolutely from the board, and ESG or climate risk or biodiversity risk is considered a leadership issue. It's a board level issue. So when we talk about the board level issue, you have outlined previously the factors which we need to look at when we consider the governance elements of board and how to operationalize these kind of meta conceptual frameworks such as governance into its nuts and bolts, into its building blocks, and that's wonderful. Uh, I would like to I would like to continue and add to the conversation to Simone, who is in fact a company secretary by training, uh, by talking about if ESG is a board level issue, what is the role of the board in the entire ESG governance issue or the climate governance issue? We need to talk about what board oversight uh, can happen with the topic of ESG by in fact creating a ESG committee. What responsibility lies with a full board or an existing committee, or maybe for a form or basically formulate a new ESG committee which looks at these strategic issues. Um, and in a lot of industries, ESG is becoming a high level risk, which often for hydrocarbon or from FMCG or for consumer facing brands is a significant component of the strategy. And when we talk about the board oversight of ESG issues, it's not a monolith. Of course, ESG is a meta conceptual framework of various sub indicators and tools to think through these kind of issues which relate to trust and transparency for reporting and resilience and rejuvenation and also restoration. You need to think about these kind of issues. So when we talk about the board composition will of course vary from the business which it is in, the industry. Uh, Board composition is also related to culture. Board is and board is also constituted into various subcommittees, like for example, audit, remuneration, sustainability, ESG can all be different committees within a board. So the board committee structure, composition, the kind of responsibility, the workloads will all differ. So existing company processes and practices related to the oversight of an enterprise risk management program are also related to board oversight. What are the ESG related functional areas? So for example, how does anti-bribery relate to an existing committee on the board? How do we map it onto the board? Some of the major ESG or ESG risks have been pertaining to one of the red flags which people look during integrity audits or due diligences. ESG due diligences is executive compensation, right? So is the executive compensation in line with its industry peers when benchmarked, or is it higher? So that's often a rule of thumb which is used, which the board committee related to remuneration and compensation have to look at. So the board also looks at the leadership team. So what kind of qualities does the CEO have, or does the COO or the CFO have? For example, finance, operations, technology. The chief sustainability officer is a new entrant into the realm of the board, which is a rarefied space. But as climate and ESG issues become material, and the concept of materiality is fundamental to the concept of ESG, what issues are material to the board in terms of strategic oversight? Professor George Serafem from the Harvard Business School has written a beautiful book called Purpose Plus Profit. In the book, there is a beautiful example which states that what is decided at the level of the board and its interpretation or its conceptualization or understanding of the same issues at the shop floor can really be like a Chinese whisper game, which which can completely misinterpreted at various levels of the hierarchy. So how is the board really trying to communicate such strategic decision making through the various bureaucratic loopholes and hierarchies within the organization? Next slide, please, Simone. So when we talk about the board, so some boards might retain primary oversight for sustainability issues at the full board level. These are particularly suitable for smaller companies or smaller boards with a limited number of independent directors who may serve on all board committees. So all organizations are not behemoths. They are not Fortune 500 companies. They might be medium-sized companies which create substantial impact or are serving an important role in the value chain, but they might not have the scale, and hence the board might represent the composition of the kind of work it does. So it might be a smaller board. So the entire board might entail responsibility for ESG issues itself. The second scenario might be that an existing board committee might look after the ESG issues. For example, the nominating and the governance committee. This approach could help integrate ESG consideration into business functions, particularly when those issues are not directly related to short-term reputational, financial, or risk considerations. More effectively, when the development of the ESG strategy is a relatively new focus area of the company. So you take an existing subcommittee of the board, which deals with a particular sub-issue, and they tackle the ESG strategy of the company in terms of the long view, right? In terms of the big game, the macro picture. Next slide, please. So the third scenario in the board oversight composition is what happens when we form a new standalone committee for ESG matters, which is beautiful because if you start something from scratch, you are able to reimagine the script. So a new ESG committee is formed. So it's structured to include representatives of audit, compensation, governance, risk, regulatory, or any other company which deals with specific material ESG issues. And the board streamlines reporting on ESG matters to the ESG committee itself. Or it might happen that all these wonderful subcommittees of the board, right, which includes audit, composition, governance, risk, regulatory, are all presented oversight of specific discrete issues of related to that topical area, but related map to ESG, right? So they provide periodic committee reports to the full board in that context, and responsibility of a committee might also be entailing according to its effect, according to knowledge and experience, which also translates into effective board oversight. For example, you might be having a particular topic related to, for example, risk, and risk might entail environmental risk, it might entail geopolitical or even social risk. So risk in terms of consideration might be considered, might be referred to a particular subcommittee of the board. So since ESG matters already fall within specific committee areas of responsibility, it is ideal to formally delegate these specific discrete material issues to existing committees so that you don't form a new committee in that context. So this happens in many organizations. Next one, please. Okay, now we drill down to practical examples, which are always much more fun than reading out text and theory. So AP Moller Maersk, which is a Danish behemoth of a company which used to rule the waters of the high seas as one of the shipping majors, and also it does a lot of work in renewable nowadays in terms of having offshore wind platforms, offshore solar platforms, and it has really accelerated transition in the sphere of marine decarbonization as well. So, for example, what do you do with the ballast water? What do you essentially do with your ballast water? What do you do when you comply with the International Maritime Convention protocol standards? How do you actually govern that element? Or AP Moller Musk has been on the forefront of transitioning onto the new carbon economy, right? They are moving from traditional industries onto renewable, and they're major player even in oil and hydrocarbon exploration, which they're retrofitting the same expertise into doing offshore wind, which in the North Sea, which in Scandinavia is really very, very important. So as far as the governance structure of ESG in Musk is concerned, so there is a board of directors. There is executive leadership team, which they call it the ELT, but ESG is mapped onto strategy, corporate responsibility, and finance. But there are also ESG relevant board committees related to transformation and innovation, audit and remuneration. There are executive leadership committees which are also ESG mapped to ESG, such as risk and compliance, which is fundamental investment committee, because you take money of international markets, or take money from green bonds, and do a lot of carbon and green financing if you are doing if you are engaging into transition instruments. So in that case, they also have a specific decarbonization steering committee, which is wonderful, which is beautiful, right? So as far as the specific ESG functions are concerned regarding climate change and biodiversity, they have mapped specific professionals within the company to specific themes, which is really outstanding as far as spending accountability is concerned, and responsibility, which calls for a lot of clear thinking in terms of accountability. In terms of social, they have drilled it down into its bare bones, such as human capital, DEI, and diversity, equity, inclusion, human rights. Employee relations and rights are separate from human capital, which they're super specialized over there. Safety and security, which is very important for a company which is into shipping, and also have pinned responsibility for sustainable and inclusive trade, which is really pioneer as a level of a climate board is concerned. And as far as governance is concerned, they have specific issues which are pinned to governance, is pinned to sustainability. Business ethics is absolutely mapped to compliance, which makes sense. There is also data ethics, which is linked to the technology team. And there is a leadership sponsor pinned to each and every sub-function within a vertical of ESG, which is again linked backward integrated into corporate sustainability strategy and finance, and onto the leadership team and onto the board, which is absolutely an ideal example of a climate board, in the words of another proud Dane called Halle Bank Jorgensen, who has written this wonderful book on climate boards called the Stewards of the Future, where she calls for specific board configurations to respond to the climate era. And this particular Danish company is speaking to that example in terms of a competent board, in terms of a competent climate board, rather. Next slide, please. So next example, we move down to terra firma. We move down to Vedanta, which is a natural resource mining extractive company listed on the FTSE in London, with global operations right from Sasagoa to Zambia, to Australia. And we see a lot of chatter, we see a lot of visibility of Vedanta RFIs regarding decarbonization and retrofitted feed-in tariff renewable energy power projects, right from Mint and the Economic Times, where there is plenty of activity on the ESG front, which clearly can be seen from an observer analyst perspective. So Vedanta has a ESG committee charter. The purpose is to assist the board in meeting its responsibilities in relation to ESG matters arising out of activities and operations of its company and the subsidiary companies, for aiming towards enhanced sustainable development. Because for a resource extractionary company which deals with minority, marginalized, vulnerable communities, and also mining's impact on the environment, which happened in Orissa. The case in Orissa and Goa was particularly blown up in the media, and also Starlight in a way as well. So mining companies, resource extractive companies, are at the forefront of the energy transition, right? A lot of these minerals which are mined are used in solar panels, are used in EV batteries. So even the cleanest of the emission transition technologies or the clean energy technologies also use a lot of old school metals which arise from mining companies. So the members of the ESG committee are headed by a chairperson who is a non-executive director. The ESG committee has a minimum of 3 members, including one IED, which is a non-executive director of the company. Other members of the committee may be appointed on the recommendation of the group CEO with the approval of the board. The group HSC and the sustainability head and director hyphen ESG, which is the ESG director, are permanent invitees to committee meetings, which makes sense because you have both health and safety, which is a top priority in mining, as well as sustainability, which is linked to a lot of reporting and disclosure work, which happens on behalf of mining companies. And meetings are at least held twice a year at such intervals as may be deemed appropriate. Any two members of the board can meet, of the committee can meet, which must include the presence of at least one board member. Next slide, please. So there are roles and responsibilities of an ESG committee of a board. So primary responsibilities are to review the policies, procedures, standards, and guidelines regarding company projects, operations, comprising of environmental, economic, social responsibility where the group operates. And the group operates in fragile contexts. They operate in economically backward areas in various parts of the world, which involves direct resettlement, land acquisition, engagement with very, very vulnerable communities. So this is a rather critical part of the board to ensure that its ENS standards, policies, and procedures, environmental and social, are reviewed at the board level. There are also a mandate for reviewing targets for ESG performance, and also report to the board. They have to report to the board with respect to appropriateness, time horizons, and also assessing progress towards those achieving the targets. Which it's not only important to set targets, right? It's also important to review targets at regular intervals, and also to see whether adequate progress has been made or not, and also seek updates on the management of material ESG issues from the respective functional and business heads. For example, what are the material ESG issues for a mining company? It might be human rights, it might be community welfare, it might be pollution prevention, for example. Where do your mine tailings land up? How are you disposing of your hazardous waste? Is a material issue for a mining company. The review and the review and report um, aspect of the committee is important because they report the performance of ESG material issues to the of the group and the group companies with respect to the implementation of ESG management systems, which are of course there organization-wide to ensure that commitments made in the policy are translated on the ground, and also sustainability and reputational related risk are being assessed, controlled, and managed effectively. Of course, these include health and safety, environmental policies, sustainability topics such as climate. Climate is important because of carbon emissions, human rights, indigenous people, because vulnerable communities are there. And also, these are essentially frontier risk areas according to a materiality of a mining and resource company. Also, often overlooked aspect of the board is review the political contributions made by the company, because normally resource extractive organizations operate in fragile contexts, which are in countries which might not necessarily have the best practices regarding regarding operations at the country level are concerned. These might be in Africa, these might be in countries in Asia where systems of administration might not be perfect. And also seek updates on how ESG is being institutionalized across all levels of the organization, and also recommend, when appropriate, suitable amendments to ESG and sustainability policies or to the ESG management system. Next one, please. In order to continue on the roles and responsibilities of the ESG committee, is to review the methods of communicating Vedanta sustainability performance, including the sustainability and ESG report, the BRSR, which is the business responsibility and sustainability report, which is the Indian variant of the ESG reporting framework mandated by SEBI for the top 1,000 listed companies in India, because a large part of ESG is our communication, is our risk communication, is about managing its reputations. And ESG, if a company does well, if a company makes significant investments on that front, is also to ensure that its reputation is safeguarded, its brand is safeguarded, it is looked up in the media and in the general public and the investor and the investing communities as a stock, as a brand, which is credible, which is trustworthy, because everything translates into ratings at the end of the day. And if your ESG ratings are not perfect, are not great as benchmark vis-a-vis your peers, it might entail that investor interest might not be significant, which of course impacts the bottom line, because Vedanta or most of the mining companies are listed on some publicly listed index globally, including the London Metals Exchange, which Vedanta is, or the London FTSE. Advise the board on aspects of diversity, and diversity might be gender, diversity might be minority representation, diversity also might mean that you need a specific talent on the board, on the committee, which will make a difference to the performance of the ESG committee and the board vis-a-vis ESG material areas. Also advise the board to discharge its responsibility vis-a-vis the law and the international standards of sustainability and governance. For example, there are hard laws and there are soft laws. Hard laws are what are regulatory compliant laws, such as the 4 industrial safety standards, which are right now reorganized according to the 2019 Act. It also means that the company, when it's taking money from the international lenders, have to adhere to equator principles, international financial cooperation performance standards, 2, 5, and 8 regarding social and vulnerable communities. It also might entail GRI mandated sustainability frameworks with regard to sustainability reporting. So it is a wide array of sustainability standards and environmental and social standards which they have to adhere to, uh, provided what is the exact nature of the recipient audience of these standards. So a large part of sustainability communication or risk communication is how you're perceived in the media regarding your HSC, regarding your sustainability performance. So are you seen in the media in a credible manner? Are you perceived in the media in a credible manner? So there's something called a social listening which happens, which is done by sustainability teams of organizations, which map the perception of the sustainability brand in the wider investor community. It last but not the least, they also perform the duties and responsibilities which are consistent to the purpose of the committee and as the board or the committee shall deem appropriate, which means that on top of these fundamental roles and responsibilities, if anything else is mandated, they have to also look at it. Next one. So there has to be a statement by the director responsible for the business responsibility report, highlighting that the ESG related challenges, targets and achievements are met. So this is very, very important as far as BRSR is concerned. So the section B is essentially related to governance. So these are all issues relevant to the G of ESG, the governance of ESG related to the BRSR report. And this series, which we are holding over the past 1 month, and this is episode 4, we have been talking about NGRBC, we have been talking about BRSR, we have been talking about disclosures, we have been talking about the various principles which go into the Indian variant, the Atmanirbhar, the Make in India version of the ESG report, which is mandated by SEBI. So the G of the BRSR calls for, in order to disclose the highest executive authority in the organization who is responsible for the implementation and highest authority responsible for the oversight of these issues. Such responsibility could be a director of the board, the committee of the board, or even a committee of his employees. Indicate yes if the entity has a committee of the board or a director of the board who is responsible for decision making on sustainability related issues, which is fundamental, right? If any director or a committee is responsible for sustainability, it has to be marked yes and no, which calls for transparency at a different level on the level of Indian accountability, right? Of Indian public boss accountability to its investors. Whether the performance of an entity on NGRBCs, which is the national guidelines for responsible business conduct, is reviewed by authority, and the frequency of its review, which is annual, half yearly, quarterly, or any other timeline. Compliance with statutory requirements or relevance to its principles, rectification of any non-compliances is reviewed by such authority and the frequency of its review. The emphasis we must have a look at it is on the keywords such as authority, in terms of review, in terms of compliance. So that's what a regulatory instrument or a quasi-regulatory instrument like BRSR does. So whether the entity has carried out any independent assessment or evaluation of its workings, of its policies by any external agency, by a yes or a no, or if yes, then provide the name of an agency. Basically, it calls for assurance of your BRSR report. Why is assurance important when you're already doing the compliance? Because as there is a data deluge of various frameworks which are emerging, cropping up every day, and it's an alphabet soup, investors might look for an additional layer of trust and transparency with regard to your sustainability data, with regard to your ESG data. So how it can be done? It can be done by third-party assurance, by an audit of your BRSR report, so that whatever you have mentioned over there has an evidence trail and has somebody who has verified what you have stated, in order to almost like insure yourself against a greenwashing allegation of sorts. So, by the way, to just add, we will be holding a separate assurance webinar on ESG reporting in the near future, in the month of January. So please stay tuned for that. We will certainly contact all our participants of this webinar and the previous webinars through an email, and you can join us for that. Next one, please. So, so when we talk about um, uh, a positive framework towards governance, right? Something which has to be done, which is a next practice almost, which is a positive measure. Board oversight might consider feedback from relevant stakeholder engagement exercises, right, with regard to the company's ESG strategy, to demonstrate meaningful ESG reporting. For example, engage with your stakeholders who are relevant to your ESG performance, right, and have a board oversight of that, which is important. And the board also might include the stipulated inclusion of key performance indicators of ESG targets, right? For example, a quantifiable target regarding ESG might be emissions reduction or energy use improvement, right? Which is quantifiable in nature, which makes sense because you can deploy sensors and meters and do the math, and then a software can record it, and you can demonstrably show your environmental performance or your ESG performance regarding the same. Next is companies can also choose to add directors with certain specific expertise with regard to certain ESG areas, which might be important strategic business issue. For example, EV mobility, or AI, or cybersecurity, or transformation. Add somebody who has a subject matter knowledge, credibility, who adds that intellectual ballast to the board. And also build cross-functional teams with clear leadership that can ensure successful integration and operationalization of ESG strategy across functions. One of the key critiques of ESG is that mostly ESG is done by single issue specialists. What do I mean by single issue specialist? Single issue specialist is a person, for example, somebody who is hyper specialized in carbon, or for example, somebody is an ecologist who knows only about biodiversity, but knows absolutely nothing about the G, what we are talking about in this webinar. So have teams at the executive level which know various aspects of ESG material issues. And it is not necessary that a social expert might know something about EV mobility. So, so bring people on board who have distinct expertise, but somebody also who can bring these people onto the same page and create the value where it is to be created. And also an organization which communicates a strategy to the market and quantifies this broader contribution, which it's not only about communicating, but it's also about communicating the value creation, which is being done genuinely and organically and in a non-green washing manner. But in order to communicate this to your stakeholders is also very important, because one of the key values of ESG is communication, is about communicating responsibility, reputation, and respect. And also to make sure that whatever you report is credible. So that is fundamental. Next slide. So we have reached to the end of the presentations, at least by Simone and me. And at this juncture, I would request Simone to run the poll for the participants of the webinar, which will be a short one, which will be a short interlude. You are requested to participate in the short survey at the moment. We have a few more seconds to go. So after this poll, we would invite the participants of this webinar to pose their questions in the chat box, to raise their hands, and also to ask for any clarifications or questions, and we would be happy to answer them, both Simone and me. Thank you very much, Simone. The floor is over to you for the facilitation.
Attendees can now post their questions in the live chat box or raise hands or write to us at esg@lodaco.com.
Hi, friends. We will be happy to answer any particular question. Please do raise your hand or pop it in the chat box, and we can engage and have a conversation on the same.
Sir, there is a question. Hello, there's a question from Mr. Prashant Rajhans. Hello,
Okay.
I have question. Some of ESG assessment certification has requirement to allocate ESG key performance indicator for board of directors. So how can we integrate this?
Yeah, thank you so much, Mr. Rajhans, for your question. We appreciate your time for joining us today. As far as uh, allocate the KPI for the board of directors, of course, depends upon what are your material issues for your organization and how do you actually translate it onto board priorities at the end of the day. If you are from a construction sector, for example, then one of the key performance indicators could be, I might not be particular pertaining to your context, but it might be the use of solar panels. How much renewable energy do you use? Or for example, if you are a construction company, do you use recycled fly ash from power plants into your cement, which you eventually use into your construction? Or for example, on the S side, if you're using migrant workers who come in from other states within the country, uh, are you providing them the right welfare measures which they need in order to stay safe and secure from a health and safety perspective? So the key performance indicators can vary from case to case, however, and can be decided at the board level and can be communicated by your compliance function as well. In case of a detailed conversation, please do feel free to reach out to us, and we would be happy to have a call with you. Thank you so much. Thank you so much, Mr. Rajans. I can see a hand raised by Mr. Amardeep Singh. Can you please unmute yourself and ask the question?
Hi, am I audible?
Yes, sir, you are. Thank you so much for joining us.
Thanks, Shankar, for your detailed presentation regarding the importance of the board. And I can second your opinion that before starting work on E and S, it's important to frame the G first. It's the board who is going to take over the strategy overall. So it's important that board create this framework and listen to the stakeholders. So I have few questions, but in the interest of time, I will try to integrate all into one. So, because the foreign investors are also participating in these as a shareholders, so it's not just for them that you have to fulfill the local regulation. You have to see how you can fulfill the global best practices into your organization. And there are some deviation, as you know, especially in governance part. So definition of independence, there is a tenure condition for some stock exchanges, but in some exchanges you don't. The director can be have a long tenure, more than 10, 20 years, and still considered independent. There are different regulations regarding gender diversity in some market. In developed market, we can see that 40% now. Some countries are going to 50% also for gender diversity, but in India it's very less, at like minimum one or two. And then in family firms or some other ways, we can see that we have seen protest from the companies that MD and chair can have a separate position or it should be combined. But foreign investor would also want that position to be separated. For remuneration, we have seen some countries are putting a say on pay, and in India there isn't such a condition to have a shareholder proposal regarding this, and other things. I can keep counting the deviations. So, as a board, I was curious to understand how board should take these challenges to, should they look at the shareholders from foreign, or should they look at local shareholders to fulfill their feedback or demand? When you say stakeholder feedback, now if you go to the foreign stakeholder shareholder, they will give different feedback, and then local would just want to comply with local regulations. So as a board, how challenges or how difficult it would be to listen to all stakeholders and fulfill all these global best practices rather than the local ones?
That is a powerful point as well as a question, Mr. Ramandeep Singh. Thank you so much for listening closely and for responding so thoughtfully as well. I would attempt to answer this rather complex omnibus kind of a question which you have integrated. I would like to go back to the first principles of ESG or reporting, which is materiality at the end of the day. What are your risks and opportunities? Who are your key markets? Who are your key stakeholders? For example, if you are export-oriented firm to the EU or to the US or Canada, right? Then of course, how the board composition should look like will also reflect what are the expectations from your consumers, right, or from your stakeholders, essentially speaking. If you are a domestic centric company with a regional market, and if you don't have FII, a foreign institutional investor interest in your firm, which can be reflected in terms of which mutual fund invest in you, which institutional financing organization is investing in your stock, then of course it will kind of vary, because whom are you ultimately selling your product to? Whom are you taking money from? And what are your future considerations as far as your product, your business is concerned, will have wide ramifications on whom you will ultimately listen to. So of course it's a matter of negotiation, it's a matter of thoughtful engagement, but ultimately a board or a company has to figure out whom he has to talk to, right? Who is the audience you're talking to? Ultimately, one of the major things which we pointed out in our presentation about Simone and me were ultimately about whom are you trying to speak to? ESG is also about communication, it's about risk communication, it's about reputational risk. So what are you trying to communicate, which also matters, which eventually will boil down to your governance thesis, almost like an investment thesis. You have a governance thesis. What is your philosophy? What is your understanding? And what is your ESG thesis ultimately? What values do you believe in? And what do you want to then translate or crystallize into indicators for your board, for your management team? So it is a very broad answer, but at the core of it is, who is your audience? Whom are you speaking to? It should rather be like a North Star. Well, in this context, I hope I try to answer it, Mr. Singh.
Yeah, thanks. So I have just one follow-up comment. If I would say, these SRI funds, these ESG funds, so they are trying to, not just local ones, but the foreign one, they are trying to capture those companies which are having this checkbox of global best practices. So if a company want to increase its foreign investor base, they would like to have, those global best practices into place so that they can be part of those indexes which are called as SRI funds. So that's where I was thinking that it become a challenge that if you're following just local practices, then you can miss out those funds, be part of that indexes. So that was, I was curious to understand. But thanks.
Absolutely. Thank you so much for your follow-up comment. I do understand that SRI is not new. In fact, SRI predates ESG funds. SRI has been around from 2008, 2006 onwards, even before the financial crash. And actually, the social impact funds are honestly, if you are in a space which is healthcare, for example, investors from a socially responsible fund would be an attractive proposition for you. So it again boils down to materiality. Again, what kind of investor do you want to attract? Whom are you speaking to is ultimately the question. But this has been a very valuable dialogue. Thank you so much. I would invite other friends who are with us in the Zoom room to also contribute and pitch in. Well, if there are no other further probes or questions at this juncture, I would invite you to join us for our next episode, which is next week. And I wish you all, on behalf of our team, very, very happy New Year. Over to Simone.
Thank you, sir, for giving us an overview on the governance aspect of the ESG framework. Thank you, everyone, for joining us today and giving us your time. We look forward to keep the ESG conversation going in our next upcoming episode, which will be held on January 6th, Friday, 4 to 5 p.m. Thank you.